All right, good morning, everybody. One more installment of Cafe con Luis. And today we're talking about the rebound. Are you ready for the rebound? Are businesses ready for the rebound? And we have a wonderful guest joining us today, Deputy Chief Economist at RBC, Don Desjardins, which I'll introduce shortly. So we do have an interesting set of questions that I've prepared for Don today, primarily to learn about the economy, macroeconomics, inflation, and what needs to happen in the recovery. A little bit of housekeeping. We are using a new platform. It's called On24. For our IT crowd, I would call this the Android of webinar platforms because you have full customization capability. You can move things around as you like, full control of your settings to feel completely in control. And so there is a few different controls at the bottom which might be relevant. The media player is where you'll see things like the slides. So our video will come up on the media player. The Q&A button, please use that if you have any questions throughout, and we welcome your questions. In fact, anything that you think of, please throw it in there. We'll try to address it as we go through. We'll be presenting a couple slides just at the beginning here, but primarily we'll just have a conversation with Don. We have some links that we'll send out from some of the studies and research data and market information that RBC publishes on their website as well. Just make it available to you here also for your benefit. We have some speaker bios available too. And at the very end, we may ask you to click on that survey button to give us your thoughts on this session. If you have any questions throughout, we also have Lindsay and Helen behind the scenes available to assist with any logistical challenges you may have. And hopefully you're all well on your way to enjoying this conversation with Don. So my name is Luis Giraldo. I'm the host of Cafe con Luis. Myself, I've been an MSP owner for the last 15 years and been working with Enable since April of last year. And yeah, I have a unique interest in this financial topic. And so I decided to reach out to some of my people in banking to see if I could land an interesting guest. And I was served up the wonderful Don Desjardins. Don, welcome. Thank you so much for being here.
Oh, thank you for having me. It's a real pleasure.
So you've been with RBC for some 15 years, if I'm not mistaken, and so lots of experience in capital markets, in economics, and your team. Tell us a little bit about what your team does at RBC and some of the research and market information that you guys put out.
Well, we're a team of about 20 people, and our main goal is to inform our clients about what we see happening in the economy, what emerging trends we see. We're looking at a lot of thematics in terms of, what's the new labor force look like? What are some of the skills that will be needed by workers as we go forward? We took a really hard look at small businesses early in the pandemic to see, what was their state at that moment, and how was this going to impact them? So our role really is to look at the data, to think about the data, to try and put it in a framework that allows us to forecast how we see our economy evolving domestically, and of course in a global economy, where the opportunities are for growth, and really bringing it back down to what is the status of balance sheets for Canadian companies, for Canadian households, housing markets, interest rates, just all the normal economic data. We try to frame it now with perhaps a more forward-looking perspective, and trying to look at some opportunities as we go forward.
Yeah, awesome. So, right off the bat, you mentioned a couple of things that are super interesting, specifically with the IT crowd. One of that was the labor market and, the labor forces. Obviously, the pandemic has perhaps changed a lot of the perspective on remote work, hybrid work, and all these things. And I myself have noticed some trends around people basically not interested in even considering a job where remote work or the option of remote work or hybrid work is not a possibility. And so I hear a lot of IT companies that are the typical partners or customers of Enable commenting on how difficult it is to hire. Not that this is new, by the way, but previously we've heard that as well. But now more than ever, it seems like there's an interesting labor shortage. And then on the other hand, you see people commenting, it's like, oh, there's no labor shortage. You know, if you pay enough money, people will turn up. But that's obviously not something that everybody can do. And so I'm curious what you've seen in terms of the labor shortage, how much of it's being driven by people looking effectively because now this newfound remote and hybrid work capabilities. So just your thoughts on and trends on the labor shortages that we're seeing across the board.
Yeah, and I mean, certainly it's a very good point. And it's certainly what we're hearing from companies in surveys, not just in Canada, but really across the world. You know, companies who have been able to work their way through the pandemic. And in some cases, these are professional services companies, right? They didn't have to stop working because they were able to work remotely in many cases. And they've continued to grow in terms of their output, in terms of the number of people they employ. And these are some of the areas in the economy which are reporting labor shortages because they're continuing to voraciously snap up people as they continue to grow their businesses. And as the economy reopens, you know, we think that demand is going to persist. So certainly it is the case that there are labor shortages in some industries. Now others, as we know, have been very badly hurt by the pandemic. They have had to have people who they don't, you know, they aren't maintaining their payrolls necessarily, but as we reopen, now they are the ones that are quickly trying to find people to come into their restaurants and bars and shops to, in fact, serve their customers that are only now able to enter their premises. So I think, you know, when we think about these labor shortages, there's another component of it, and it is this mismatch in skills. So, you know, for some of your listeners, certainly they may not be able to hire people because people don't have the skills that they require to be able to do their jobs. So that's also something I think that the pandemic has really highlighted, that, you know, we've seen jobs being created in the higher wage positions as we've worked our way through this crisis. The lower wage workers who tend to have less education, those are the people who are still, you know, on the sidelines waiting to get reemployed. So it's that mismatch, I think, to some degree that is, you know, creating these labor shortages. And also, we've also seen people, and this is in particular in Canada, the survey, but showing that people are leaving their jobs because they're unhappy. So it could be very much to your point. Oh, you mean I really have to go there 5 days a week? Right. I'm going to go and look elsewhere, right? So I think, you know, there's lots of factors at play here right now that, in fact, make it a challenge for businesses to get the right people.
Sure. Well, and for the audience as well, RBC is a Canadian bank, and a lot of your market research and focus is on the Canadian economy in particular. But we've always thought of the Canadian and U.S. economies to be joined at the hip, so to speak. And so I'm curious how much of this market data sort of is replicated on the U.S. side, or if you track that closely enough to be able to comment on it. And I'm interested in sort of why is it? Because obviously there's other countries in the G7, which you could argue have a similar advanced economy, and but other countries in the G7 don't follow the same type of relationship. You know, is it the long border? So I'm curious about your thoughts on that.
Yeah, well, I think in the U.S. what we're seeing is job vacancy numbers are extraordinarily high. So there's lots of job vacancies. Now, in the U.S., they haven't had as robust an employment recovery as we have had here in Canada. Now, in some markets, you know, people are saying, well, people have had all these extended benefits by the government. Now, about half the U.S. states stopped those benefits in July. So it'll be interesting to see if we start to see more people getting jobs, right? Because for lower wage workers, you know, they were more than compensated to not go back to their jobs. So that's going to be an interesting development, I think, for the U.S. Labor market as we go forward, because the jobs are there. The data, you know, the vacancy rates are very, very high. When we think about Canada's trade relationship with the U.S., you know, obviously longstanding, right across the border, as you say, it is location and proximity that drives a lot of that relationship. Canada has, over time, we have a lot of trade deals, with Europe, for example. So, we are certainly trying to broaden in terms of our markets, but just what we've just gone through with the pandemic, with the supply chain interruptions, it does sort of see us going back, I think, and, continuing to have a very strong relationship with our U.S. partners and, send lots of commodities south of the border. Lots of our industrial machinery does go south of the border as well. So, this is where 75% of our exports go. And as the U.S. continues to grow, which we do anticipate will be the case, that will, we think, seed some good demand for Canadian exports. It may take some time and it may not be, instantaneous, but we do think that is going to be the case as we go forward.
Sure. Makes sense. So for our crowd in particular, I think many of the IT companies that are likely attending are interested in understanding how the recovery will affect the customers that this industry serves, the small businesses, small and medium enterprises. And so I'm curious your thoughts on, especially with some of the government programs slowly winding down or coming to an end. Some small businesses have been very dependent on the government programs. Is there a potential for these to end up insolvent as a result? Will we see sort of a little bit of a dip in labor and or opportunities because of these businesses basically not being able to support themselves just yet? Or do we see potentially a more concerted recovery across the board as not only the borders opening on August 9th coming up for Canadians in particular, I think the spending of U.S. dollars in Canada drives a lot of our economy as well. And so forgive me for the very large amount of mixed thoughts there, but I'll let you comment on sort of the small business recovery, I guess, and the ending government programs.
Yeah, well, certainly, small businesses did take advantage of some of the programs that the government put in place, whether it was the business loans, 0% loans, and with some prospect of forgiveness if the companies were able to pay them back by 2022. So I think we saw a lot of small businesses really, taking advantage of that simply because they had no source of revenue coming in during the worst of the pandemic. And as we've emerged from the really intense lockdowns, there have been some industries that, continue to suffer. Food, accommodation services, other services where you needed a person-to-person contact. Like they really didn't ever get back to their full strength. But when we look across the entire economy, other small businesses were able, to reopen. What we've seen in the data is that small businesses do have higher levels of debt exiting this crisis, as one would expect, when they entered it. Taking advantage of those loans was great to get them to the other side. However, as we move forward, it really is going to be the strength of the reopening and the strengthening in demand that is going to help them get through and whether or not they are able to survive this crisis. Now, there are those hard-hit industries, and certainly there, you're probably going to see more vulnerability. Now, the data doesn't show us any of that yet, simply because the programs are still there. And so, as we go into the fall and into 2022, that's when we're probably going to see any holes in the economy if companies, aren't able to fully reopen and to really regain some of that ground. And, it's all very dependent on the vaccination rates, which we know in Canada are very high. But it's, continuing that trend. And it's, of course, the effectiveness against the variants, still to be determined. It seems like they're working, but, so if we have to go through another period where we have more shutdowns or we have to, close up those very vulnerable parts of our economy, of course, that intensifies the risk for those companies as they look forward. So, our baseline view is that we assume, that we are now going to be in a more sustained, a more fulsome recovery in Canada and in the United States. So, we think that is going to be the case. And that's what really supports our forecast. We have the U.S. economy growing very strongly, helped by continued fiscal stimulus put in place by the U.S. government. In Canada as well. I mean, the U.S. is about a quarter, I would say, ahead of us. We're going to get data later this week. Probably going to show us a double-digit increase in growth for the U.S. in the second quarter. So that's pretty darn strong. And we think it's going to maintain a solid, not double-digit, but solid increase as we go through the second half of this year. For Canada, that third wave hit us a little bit harder. So we had more intense and longer slow shutdowns. So it'll probably be slower, and it'll probably be the second half of this year where we'll see a real acceleration in our economy. So for all of these smaller businesses that now are just being able to reopen, this is sort of where we're going to see increases in their activity, increases in their hiring, because certainly surveys suggest that, that these businesses have become more optimistic as we've been able to see more people vaccinated, and they're intending to really get their businesses reopened, and that means they have to rehire.
Yeah, interesting also, obviously all the governments in the U.S. and Canada, at least, with the amount of cash flow they're injecting into the economies, whether through loans or other programs of that nature, this is probably one of the drivers of now the inflation talk. And so I wondered if you could comment a little bit on all the talk there is about inflation, the rising inflation rate. And one of the things I noticed in particular is how bullish people are on the comments about the inflation being temporary. And sort of what is the supporting data that says, oh yeah, it's only going to be temporary, or if this is really just a crystal ball. Curious on your thoughts there.
Yeah, the sharp increases we've seen in most countries, advanced economies, really reflects a few things. One is that in 2020, prices were declining throughout March, April, and quite low in May. And so it's just a math thing. As we reopened, those price increases, and that's boosted these comparators. So it's an inflation rate which compares prices a year earlier. So that's why we've seen these significant increases to some extent. But I'd also say, as we reopened our economy, as we've seen, input costs rise significantly, as we've seen freight costs rise significantly, this also is at play, and that's also putting some upward pressure on prices. And now as we go forward, we're thinking about all of these labor pressures, these shortages, and talk of, you read stories in the newspaper, we had to give a signing bonus, or we had to give a higher wage in order to entice people to come to work for us. So there is some chance of wage prices also filtering into the overall prices. So for companies, they're sitting there, their inputs are certainly rising. We've seen those, input costs rise. There's some prospect that they may see even their wage bill also picking up. So it becomes the question, is this sort of a continuum? Are we going to continue to see that? So we'd say, okay, the transitory part that people talk about is the math. Okay, that's fine. So the next stage has been the input costs. And now we're starting to see some suggestion of wage push pressures. Is that sufficient to really sustain upward pressure on prices that businesses have to pass along to consumers? Now, our take is that we're going to live in this higher inflation rate world throughout the end of 2021 and entering into 2022. It won't take a lot of increases in prices to get us there. But as we go forward, and it's a response, right? Your companies know, once you get all this pent up demand, supply comes on board, right? People start to build new companies. They start to introduce new supply into the market. And as that happens, that takes a little bit of that heat off those price pressures. You just have more supply coming on stream. So we think that's the likely outcome, but you'll still be living at the end of 2022 with inflation rates that are higher than they were when we entered the pandemic. You're probably in the 2.5% range, which isn't something, we've seen for quite a while on a sustained basis. But we think, in the US where it's 5 and Canada's in the high 3s or mid 3s, probably that won't be the case as we go through 2022. But again, it is a risk that, agents in the economy just begin to expect those higher inflation rates. And it's that inflation expectation, right, that fuels price increases.
Right. Yeah. Well, the other interesting marker of that, especially in the Canada-US relationship, is obviously the exchange rate between the US and Canadian dollars, because right at the top of the pandemic, we saw the price of the loonie drop considerably with respect to the US dollar, but then gain a lot of traction as the pandemic proceeded. And so it's interesting how much that drives Canadian spending in general, because a lot of Canadian spending is in the tourism industry and travel, and in the US in particular. And now I hear RBC reporting that we may have hit the peak of the highest values of the Canadian dollar so far, and that we might just see it as the US dollar strengthens again, as the economy reopens, we'll see that sort of gap increase as well. And so I guess that adds another factor of potential perceived inflation to the equation as well.
Yeah, I mean, I think our view on the Canadian dollar, so it rose to 83 cents earlier this spring, and it really reflected the fact that, the Bank of Canada looked, more willing to start to reduce the amount of monetary policy stimulus that he was providing to the economy. Whereas in the US, Fed Chair Powell was more, this is a temporary rise in inflation. We have to ensure that we have a very fulsome recovery, and in particular, labor market recovery, because they do have that dual mandate. And so I think what we were seeing was, people thinking, okay, the Bank of Canada is going to be more aggressive than the Fed. And that underpinned it, alongside, of course, the fact that oil prices suddenly went to, back into a very strong place. And so those were factors that gave that Canadian dollar a lift, as well as the fact that, investors were looking for returns. And so we had a lot of demand for riskier, quote, quote, assets, equities. So Canadian dollars kind of get bumped into that riskier asset bucket. Now, more recently, the Federal Reserve's changed its tone, not a lot, and still not probably going to be doing anything on interest rates till the latter part of 2022, but just sufficiently that market expectations moved a little bit, and that took a little bit of shine off Canada's dollar. So it's, I think 79.5 cents against the US dollar. We think it's probably going to hold in that range, probably around 80 cents by the end of the year. Just kind of little bit of volatility there, and then remain around that. I think we have it moving to about 78.5 cents by the end of 2022. So it's not going to be a huge factor, I don't think, in the inflation story for Canada. If anything, just given where the currency had been previously, it is actually a reduction in import prices, just because the currency has improved, right, compared to the 70s, where we were looking at the Canadian dollar's value against the US dollar previously.
So it's interesting to me, you talked about some of the challenges that are driving some of the market prices, and supply chain challenges have certainly been part of that. In the IT industry in particular, very well into, or early in the pandemic, we saw laptop availability very low. The chip shortages were contributing to that as well. And something that strikes me as interesting is that IT companies, I think generally speaking, are pretty terrible at adjusting prices to accommodate for market fluctuations and or rising prices and or passing costs along to customers. And so it dawned on me that perhaps all small businesses are terrible at adjusting prices to accommodate market fluctuations. And so I'm curious if you have any insight or recommendations or best practices for if any small business that you were talking to say, hey, maybe consider adjusting prices or raising prices, based on these markers. What does inflation tell me that I should do with my business and my pricing? Because for IT companies, rising costs are a real issue. If we have to pay suddenly $10,000 more to a technician to actually do the same job they were doing a year ago, then how do I recoup that? And raising prices is always a tough conversation. So I'm curious how you sort of give advice to a small business to consider the time continuum of raising prices.
Yeah, I mean, the pandemic has certainly injected a lot of these price pressures. Just these dislocations in the market, just like you're speaking to, if someone suddenly has to pay $10,000 more on a salary that they didn't anticipate, it becomes increasingly difficult to run your business profitably. And all of these shortages that you're talking about, these supply chain shortages, have certainly, I think, really ramped up some of these input costs for businesses. Now, I guess it's a question of whether or not it is a sustainable increase. And that's sort of where this inflation conversation goes. It's like, do you think that prices are going to rise by 3.5%, over the next few years? Or do you think that it's a blip? It's this transitory increase in prices that you might just have to power through. So I think it really is probably very much dependent on each individual business and what their input costs and wage costs are looking like today. And if they anticipate, like, for example, when we think about the skilled labor shortages, and that's been, persistent in Canada for quite a period of time, right? Even before the pandemic, we had very tight labor market conditions. And what did you hear? Well, that's exactly what you heard from companies. There's no skilled labor. We really need people to. And so, we had immigration that was helping to kind of plug some of those holes in terms of getting workers that are needed. Now, we've had an interruption in that flow, of course, because of the pandemic. People could not come here. We're starting to see, as you said earlier, we'll start to see the borders reopening. That should open the gateway to people, skilled labor, being able to come to Canada to relocate. And I mean, the other thing that I think is worth thinking about is also, if we are in this hybrid world, in this remote world, in the IT space, do you actually need the person to be physically in Canada? And what does that look like? And how do you increase your search and really tap into these pockets of skilled labor? And I think that's another complicating factor that's certainly going to be in the mix as we go through the year and probably years ahead. Is there a requirement for workers to be physically in the country of the company they're working for? I think there's lots of tax implications for that, but nonetheless, right? I think when we think about, how are these costs going to evolve over time, it's very complicated. Like, we're forecasting headline inflation, as I said, to move back down to 2.5%. But that for some companies, that may be just, those costs might be too much. They might have to, in fact, put prices higher.
And of course, there may not be any reversing wage pressure increases because you can't later, or it's very difficult later to say to somebody that you paid $10,000 more to say, oh well, inflation's back down, we're gonna roll back that salary increase. And so obviously some of these things are more permanent thoughts, and people have to account for how they go and look at their own pricing practices. So another thing that's interesting, I find, is as IT companies work with small businesses, one of the key areas of growth for IT companies is their customers growing. And it's interesting to me that Visual Capitalist was reporting in the US that the number of EIN, or employer identification number, applications had spiked dramatically over the last year, meaning way more small businesses are coming out into the market. And I wondered if you are tracking similar data for Canada, or if you're tracking sort of small business growth per se, or scale. And so curious on your thoughts.
Yeah, I mean, we had recent data suggesting that since January, it has been a pretty, I want to say it's a steep increase in the number of new active businesses, but it has been trending higher over the course of 2021. And in fact, it looks like it may even be a little bit faster than the trend rate prior to the pandemic in terms of new companies coming on the market. Now, that doesn't mean necessarily that the overall population of companies is growing. The data also suggests that overall active businesses are down a little bit, and I mean, it's as you would expect, right? And this data, though, it's a little bit tricky in so much as it's only saying, did you have an employee in January, and do you have an employee in April? Now, you may temporarily not have anyone, and therefore the data is a little bumpy, so you don't want to read too much into it. But I think in general, we've seen these activity levels in terms of activity numbers, companies who are actually active. They're a little bit below where they were in Feb 2020, but that has come back a bit. And we certainly have seen, as I say, this upward trend in new businesses coming into the market. So, I think that just the general evolution of the economy, right? You have this churn that happens. Some incumbent companies, they're like, okay, I'm done. That was too much. And then you have new ones who are there to either, purchase those companies or, in fact, to create replacement companies, if you will. So, that churn is starting, I think, to become readily apparent in the data.
Yeah. So digital transformation or digital evolution is something we talk a lot about at Enable, because I think it's one of the key areas that IT companies or MSPs are heavily involved with to help their own customers scale and grow. And so I'm curious if you're seeing with any of the data, obviously newer businesses are more likely to go into the digital economy from the start, whereas older legacy businesses tend to have a slower adoption rate of new e-commerce and stuff like that. So I'm curious if you guys track in any of your data a bit of that sort of digital evolution or digital transformation that enables growth or enables scale.
Yeah, I was looking actually, because knowing you and your audience, I would look back at some data, and this is pre-pandemic, so 2019 data, and it was looking at what companies at that point said they were looking to do over the years 2020 to 2024. So, 2020, they probably didn't do it. But anyway, and what it showed was about 49% of companies said at that point they just wanted to optimize their processes. They weren't necessarily going to, move forward. But a quarter of them said, over that 4-year period, I intend to change and, move forward with my processes. So, if we assume that is the case that going forward, it does suggest that there's a pretty, 25% of companies, that's a lot of companies that are looking to, move forward with digitization processes. And I think, while it's not readily apparent in the data at this stage, one thing to watch is, are we going to see that number grow significantly? Because, what the pandemic taught us was that if you had an e-commerce site, you could continue to function. If you didn't, it was a real struggle. And so, we see that in the, stats can just retail data, e-commerce, went through the roof, of course, because that's all people could do. So certainly it is the case that while in 2019, that was where the data, I think it's interesting to see in any refresh data, did that number, that 25% that were already willing and looking forward to doing that, to really kind of move forward with the processes, did that number grow? And of course, there will be cost constraints. Some of the smaller businesses, won't be able to really do a lot of investment in the near term until they, really get their revenue stream back up. But, it'll be, I think that's a 2022 phenomenon that we'll be really watching carefully to see if that's, underway.
Yeah, a similar phenomenon that I'm sort of betting on or tracking myself is this idea that IT companies are transitioning a bit from a traditional productivity approach to IT, helping with applications and deploying IT systems and such, to a much deeper relationship of also helping digitization and processes specifically. So I think traditionally IT companies that are outsourced by small businesses have not been too heavily involved in the actual processes of the small businesses themselves. Yeah, they help with deploying the app and all those things, but really getting into the nitty gritty, so to speak, of actually helping move from that paper scanning process to that digital scanning process, and or helping research an e-commerce solution. And another trend I saw very early in the pandemic, in fact, my own IT company had a little bit of a participation in one of these, is the small business marketplaces. I saw an interesting trend where business marketplaces were popping up to try and leverage a bit of the community trust factor, if you will, of for example, we worked with one of the IT company's customers, which is Major Tom here in Vancouver. They're a digital media company, digital advertising and such. They created a wonderful business marketplace where they brought in different businesses of different aspects to say, hey, here's a trusted group of businesses to offer a slightly different approach to typical professional services. Because again, the engagement model has always been, you go sit down with a customer, you talk about your big project, and you have this long tail process of professional services delivery. But that ended abruptly, of course. Now you had to sort of consume in bite-sized chunks. And so I've seen a trend of small business marketplaces. So hopefully that'll continue. I think that just opens up the economy and the opportunity for some of the very hyper-localized businesses, especially IT companies are hyper-localized that way because there's a stigma that you need to see and talk to the person that you're supporting, or you need to go interact with systems physically. And so it creates a little bit of an opportunity to work more remotely and at a distance. I wanted to ask you—
the government has done that, right? The government has put money in place that is aimed at having companies help businesses get up in terms of their digitization of their business. So, I mean, that the federal government announced those programs. So I think that, you know, even further supports the trends you're identifying, and it will fund some of that.
Yeah, so for IT companies listening, I think that's definitely an opportunity to expand on your services, get involved with helping people figure out their e-commerce solution, or moving from a strictly, you know, face-to-face type of sales model to an e-commerce or digital sales model, because I think we'll see that as a baseline go-to-market strategy for a lot of small businesses, you know, being born today. They're just going straight to digital and trying to capture more of that market right off the bat. So when I hear the term inflationary measures, I wonder sort of what some of the forces behind that are, because again, I'm curious at which point we realize, oh, you know what, maybe inflation wasn't temporary after all. Like, what would help a small business determine whether they can expect to see some costs or inputs, you know, coming back down, or what are some of the things that would signal, you know, having to plan for a more longer term inflation, and what are these inflationary measures?
Well, I think there's a couple of things I would look for. One is this idea of wages and the persistence of, you know, wage increases being demanded, as every time you go to hire the person's, you know, the next person's up a few bucks an hour or whatever it happens to be. You know, that is where the persistence comes into play, because companies can only, you know, survive that for so long without having to increase the prices that they pass along to consumers. The other thing we look at is something called inflation expectations. And so that wage part of it is part of it. It's also how much do businesses anticipate that they're going to have to, you know, somewhere along the chain, increase their output costs. So if you know you're a manufacturer, you're selling it to the wholesaler, are you going to have to put in another 3.5% just to recover your costs? So there's the business side of it, there's the consumer side of it, and then there's the market side of it. And this is a little bit deep in the weeds, so, you know, excuse me, but, you know, really looking at market rates to say, okay, what inflation rate is actually assumed by market participants? And so are those, they call them inflation expectations, are those inflation expectations, you know, rising? Now, we did see that happen earlier, and they start to sort of level out. And so it just says that, you know, markets anticipate that prices are going to move higher to have to compensate for this inflation, which is going to be coming. It is in the pipeline. So, you know, that as economists, those are the things that we watch. We listen to what all of the surveys are telling us in terms of, you know, does someone say, well, I'm expecting a wage increase, and does the business say, well, I know I'm going to have to raise my. So all of those factors come together. And so, well, you might have those input costs, you know, over time, as as the cycle kind of takes over, more people come in to supply those goods and services. You get fewer interruptions. That could alleviate some of those input cost pressures. But is it the wage side that comes into play there?
Yeah, and I guess the learning experience here is really to try and stay ahead of some of those market demands so that you don't end up in a reactive situation. It's like, oh, well, anybody that started adjusting their prices and paying a little bit more of that hourly wage or what have you to be able to hire, did it before me, and now I'm not able to because the labor shortage is now even more pronounced. So that's awesome information. I was reading a little bit about the debt to GDP ratio, because a lot of the conversation that's happening around the government programs and all the free money is, how are we going to get out of debt as a country? Yeah. And, whether and we see all these numbers being reported about the GDP was lower than expected. And so, what is a little bit of your thoughts on this debt to GDP ratio? Yeah,
I mean, certainly globally, governments, they had to do it, right? Drove up to very high levels of debt because they had to support their population, support their businesses as we worked our way through this pandemic. They had the advantage of doing so at very low interest rates. Certainly monetary policy worked as a companion here, not because they were trying to finance the debt, but just really because they wanted, businesses and consumers not to go bankrupt. So they've had that advantage. And as we go forward, the economies will grow. So that, debt to GDP, that debt stock has increased significantly. It'll increase at a slower pace as we go forward. We're not going to rely on these programs as our economies continue to open up. The GDP portion, the denominator, well, that's going to grow. That is going to make up for the lost ground that occurred during the pandemic. And so the debt to GDP ratio as a function of that will start to move back down. Now, how aggressively and how rapidly it moves back down, we'll have to see both of those trends continuing, right? Growth continuing and debt continuing, deficits essentially continue to grow at a much slower pace. And the other thing is that during this time, as I say, the cost to service the debt has been really very manageable. Our expectation that eventually interest rates will move up. And again, it's going to take a long time, in our view, for those rates to really move up significantly. That's going to leave governments with some leeway in terms of, being able to maintain and service that debt at really low costs. But I think that, 2, 3, 4 years out, it really is going to be, people will become more laser focused, I guess I'd say, on how does government eliminate their deficits. We've had to have them. Everyone accepts that. We know it's going to have a long tail simply because they have to nurture this recovery. You can't just let it go on its own because it could really fade out quickly. So I think that it comes more of a, what does that look like? Now here in Canada, the government in its most recent budget, has put in sort of the recovery part of the budget, increasing their spending by $101 billion over a 3-year period. But then even when we get through that, they still have a 1% deficit relative to the size of the economy. So that's where we're going to, I think, start to see, how are we going to get rid of that 1% deficit to GDP? What does that look like? Or will the economy be able to create enough revenue based on this, all these investments, that it will eliminate the deficit just by virtue of more tax revenue. So, there will be, I think, days ahead for a reckoning on these deficit side of the equation and these debt levels. But it's going to take a while, I think.
Well, certainly election time will amplify the reckoning, I'm sure. I hear things during the market reports when I hear comments like, the investment community is dumping bonds and piling into treasuries. And sometimes I just don't understand the larger market effect of these things. And so I'm curious just to ask you, when we hear things like, the investment community is piling into treasuries. What does that mean at the macroeconomic level? What is, I guess, the either outlook, positive or negative outlook of the economy when that's happening?
Yeah, well, I mean, they often move into to bonds, when they're nervous about the outlook. And so what you see is, of course, that when people are purchasing the bonds, the price of the bond is going up, the yield on that bond is going down. So essentially interest rates are moving lower. And we've certainly seen these bouts of activity recently when people are nervous, are the variants going to, in fact, derail the economy? Is the economy going to go back into another downswing? So you often see it during those cases where, in fact, people, do want to hold those securities. They consider it to be a safe investment. And then you often see in a companion way, gyrations in the stock market as people go, whoa, that's a riskier asset. I'm going into the safer assets. So that's really what it is. And what we've seen, during, the great financial crisis, and now during the pandemic, is that central banks also trying to keep interest rates low across the entire yield curve, and one way to do that is to actually purchase those securities, and that so raises the prices, reduces the yield, or keeps interest rates low. And so that's what we've seen during this time. And even the Bank of Canada, which had during the great financial crisis, avoided having to do that, having to be active in the market. They, in fact, also joined the U.S. Federal Reserve, the ECB, DOE, you name it, in terms of now engaging in this quantitative easing program, really initially, the bank aimed it at ensuring that the system could continue to function. But that, we didn't really have a malfunctioning, per se, of the market during this crisis, the way we did during the great financial crisis. So they pivoted to say, okay, we want yields to be down across the entire maturity spectrum, because we want people to be able to borrow and business to be able to borrow at very low rates. And so they maintained that, but they quite quickly, in a relative basis, pivoted and said, okay, we don't really need to do that anymore. So that's where this idea that the Bank of Canada is out ahead of the Federal Reserve, for example, comes from, that, we've reduced the amount of bonds we're purchasing and taking out of the market more aggressively and sooner than the Federal Reserve.
Yeah. The other thing that strikes me, and I see this maybe even from 15 years ago, is just how much more wild the moves in the market seem to be today versus a little while back. And I wonder how much of the digital age and the access that retail investors have to the market compared to 15 years ago or 10 years ago or 5 years ago even has made those moves even more pronounced. I'm sure that has an effect that is not necessarily accord with the actual market data, and that there's a lot of knee-jerk reactions that are even more amplified as a result of that retail investor, feeling nervous or not feeling nervous, and sort of riding the trends a little bit. So curious on your thoughts, whether the retail investor is causing more problems than solutions here.
Well, I think with all of these things, one is it sustained? Like, are these big moves and then, whipping the market around? And I don't think we see it on a sustained basis. If you look over time, you'll see those lines move around a lot, but generally speaking, the trends aren't derailed by these activities. So as long as that's the case, and as long as confidence is maintained by investors, whether it's in the ability of the stock market to continue to move higher or flatline, and so that, I think, is probably more important in terms of having an impact on the economy overall. I mean, if it comes to pass that it causes a severe decline in equity values that is maintained, of course that really impacts household balance sheets. I mean, for companies, certainly that is the case as well, but for households. So if households are what we're anticipating drives this economy as we go through the next several quarters, if they come under pressure because we see the value of their balance sheet decline, and they're no longer willing to spend the way they previously would have, that's when it gets into an economic impact. And that's when we would be, really watching to see, how much is that taking out in terms of the ability of consumers to spend and their willingness, I guess, overall to spend.
Yeah. Which actually brings me to an interesting question to summarize a bit of the topic today, which is, amid drastic quarterly or even month to month or even week to week changes, how can an SMB or SME or a small business just maintain a long-term view on this? Because like the crypto market would say, hodl, keep your knee-jerk reactions to a minimum, because these trends tend to flatten out, as you say. But I think the reality is very different for a business when they find themselves, short payroll this particular month or quarter. And so I guess it's a little bit of a bet or leap of faith that things will soften and standardize or even out over time. But that is sort of, I guess, the challenge for small business. What is your comment for small businesses concerned about the now and not able to look past the 3-month or 6-month or 9-month timeline?
Yeah, I mean, certainly, I think, this is not anything I don't think any of us really have lived through, maybe a few who are in the 100+ age. But certainly it is a period of heightened uncertainty. And I do think that the fact that we have government support and their continued support, that interest rates remain very low, these are conducive and supportive factors for the economy. And for those in the harder hit sectors, it really becomes the case of trying to, just reopen, right? And stay on, trying to get your feet back under you, which I can't imagine in some of these cases how tremendously difficult that must be. But I do think that, if you're thinking about, your immediate, there are resources, of course, financial institutions and the like that can, hopefully help you mitigate some of it or manage your way, navigate your way throughout that. I think watching the economic data and watching for, as we discussed, some of the challenges and how to anticipate those challenges in terms of, are you going to hire 2 people or are you going to hire 1 person based on what you're hearing about wage demands and how does that look and what kind of processes, for many companies, of course, it is just this idea of, when do you have the funding to, make that move into digitizing your business, which is obviously very important for your listeners, and understanding, I think, what kind of resources are out there, because as the economy rebuilds, this is the time that resources are being put into place, whether it's those government programs I talked about earlier, or even like the retraining programs. Looking around for workers is extremely difficult. But if you see there are programs being put into place by governments, it's like, how do you tap into that pipeline of people to ensure that your business does have, the workers that are needed for the future, not just for today.
Yeah, no doubt. Well, Dawn, this has been a fantastic and insightful conversation. I really appreciate your experience, expertise, and depth of thought on this. For everybody's benefit, RBC has a wonderful thought leadership aspect of their website. They publish a lot of really interesting commentary and market analysis and research. I myself am now subscribed to the RBC Economics mailing list, and I get a lot of these sort of the daily musings on the markets and things that are happening. And it's been fascinating to just learn more as we go along. And this certainly has helped improve that knowledge a little bit. So I want to thank you again on behalf of Enable and myself and our listeners. Thanks also to RBC for lending your talents for this conversation. Dawn, once again, I hope you continue doing well. I'll try to reach out the next time I'm out your way in Toronto. But in the meantime, thanks for attending, everybody, and thanks behind the scenes to Lindsay and Helen, and we'll see everybody very soon.
Thanks, Luis. That's great.